All right, welcome back, everyone. Earlier this week, the Federal Reserve lowered its key interest rate by a quarter point again. Now, this is the third rate cut that we've seen this year, at least the one like this, as the Fed is working to balance stubbornly high inflation numbers and a cooling jobs market. In his announcement, Chairman Jerome Powell said the Fed is now in a wait-and-see mode as it decides future monetary policy decisions.
There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem.
All right, so right now let's talk about how this cut could impact your pocketbook with Sina Golara, Assistant Professor of Supply Chain Management at Georgia State University. Sina, great to have you here with us this Friday. So let's start with this. What does this rate cut tell us about the broader health of the economy, at least from a supply chain perspective?
Yes, so basically the Fed has judged that the labor market has cooled enough, even though inflation is still at uncomfortable levels. They are becoming increasingly worried about the labor market and jobs availability to the American people. So that's why they decided to lower the rate.
Yeah, we know it was a decision that wasn't unanimous. We know some of the board voted against it. But when borrowing becomes cheaper, how quickly, if at all, do we start seeing the costs come down?
So about the descent, when you look at the summary of economic projections, several people did not agree with today's decision. A lot of them wanted no rate cut. One person wanted two rate cuts. And so dissents are back on the table after many years. And part of that is because the data is ambiguous. Some part of the data, when you look at inflation, shows elevated inflation, which is really hurting a lot of people. And importantly, it's cumulative. So it's been happening over the years. And now the prices are way higher than a few years back. At the same time, finding jobs is becoming harder and harder. Now, so what the Fed did with dropping the rate will lower the borrowing costs for businesses. And so it should stimulate more economic activity, which might help many businesses in starting to invest again and hiring more and more people. And so that should help create some marginal stimulus for the economy.
All right. So let's talk about Georgia. We're focused on Georgia here. Are there any industries here that could benefit the most, you think?
Yes, Georgia, being a transportation and logistics and supply chain hub, it's very exposed to what the economy is doing. If the economy is slowing down, lots of movements on transportation and warehousing and all that slows down, so we will feel the effect pretty strongly. And so with more and more rate cuts, if the economy is effectively stimulated, this should create a lot of business activity because, with all the supply chain linkages that are here, with ports and seaports and airports and all the other infrastructure facilities, retail and commerce facilities that are in this region, Georgia should be starting to see the benefits of that.
Mm-hmm. And Sina, we heard Jerome Powell being pretty cautious, to say the least, there in his words after the Fed cut. Is there a danger, though, that the Fed could be moving too slowly when it comes to cuts or too quickly, specifically how it might affect the supply chain? Yes. As they have clearly mentioned, they see a lot of risks, and they actually don't have unambiguous data to go by, especially with the government shutdown. We also skipped a few reports and important data points. So things are extra ambiguous right now. And so what they're worried about is if they drop the rates too soon, it might stimulate too much economic activity and bring inflation back on the table, even though it's still not fully dealt with. So it might exacerbate it into a bigger problem. But what we see at this point is the job market is continually weakening. We actually see new graduates finding the job market harder and harder. every semester.
All right.
And so that's what they're balancing the decision on.
Yep. All right. And Sina, we'll see what happens. The Fed meets again in late January. Sina Golara, have a great day. Thanks so much.